Net revenues for the bank increased by 22.2%, which took the revenues to 9,232.7 crores. Of those net revenues, 72% was net interest income and 28% was the other income. Net interest income growth was 21.2%. That took NII to 6,681 crores. The balance 28%, which was other income, grew by 24.7%. That was to 2,047 crores. The other income has four components, but the largest component of other income tends to be fees and commissions. Those grew by 21.6% to 1,868 crores. Operating expenses were up 19.8%, so they grew a little below the growth rate in revenues. As a result, the cost-to-income ratio for the quarter was 45.4%, as against 46.3% for the corresponding quarter of last year. After provisions and tax, our net profit growth therefore was 20.5%, and the actual net profit for the quarter was 2,869.5 crores. Moving on to the balance sheet, we've had a rather strong quarter in terms of balance sheet growth. Total deposits crossed 5 lakh crores for the first time. They were at 5,06,909 crores, which was an increase of 29.7% year on year. CASA deposits also saw a healthy growth. Current account growth was at 20.8%. Savings accounts grew by 18.7%. And fixed deposit growth was 37.6%, which took the CASA ratio to 40%, and as I mentioned earlier, total deposit growth to 29.7%. Advances growth also grew roughly in tandem. The total advances growth was at 27.9%, and this was almost equally contributed by retail and wholesale. The retail loan book grew by 29.3%. The wholesale loan book grew by 23.4%, and as at the end of the quarter, as of September 30th, the mix between retail and wholesale, as per the Basel II classification, was 52% retail and 48% wholesale. Our overseas book now is about 7.5% of our total loan book. Just a couple of numbers on the half year. These are the audited half year financials. Our net revenues for the half year were at 18,083 crores, which was an increase of 24% over the corresponding half year. Net profit for the half year was at 5,565 crores, an increase of 20.6%. Capital adequacy as of 30th of September was at 15.5%. Again, a large part of this is Tier 1. The Tier 1 capital adequacy was at 12.8, which was as against 11.8 as of September of last year. On the network side, we, as of September 30th, have 4,227 branches. These are across 2,501 cities. The mix is about 55% in semi-urban and rural, which is more or less similar to what we've had for the last few quarters. So the total number of branches that we've increased over the last 12 months was 627 branches, of which 126 branches were added in this last quarter. Asset quality remained fairly stable. So our gross NPAs are just over 0.9% as against 1% as of September of last year. Our net NPAs are at 0.2%. Restructured loans again remain stable at 0.1%. So those are some of the key figures. I'd be happy to take your questions.
You said has contracted by around 10 basis points in this quarter. You've had the record of maintaining it as one of the highest in the industry. Correct me if I'm wrong, but it's most likely because of your base rate cut that you've undertaken. So going forward, as the cost of funds falls down, do you expect that to improve, and what is your target? Do you still maintain it at 4.5% for the year?
Yeah. So we've had net interest margins in a range of about 4.1 to 4.4, right? And yes, in this quarter, they have come off by about 10 basis points, which is primarily linked to, one, the drop in base rate, which you rightly referred to, The other, of course, is that we have seen this extremely strong increase in fixed deposits, and this is true both in the June and the September quarter. So as a result, the CASA is slightly lower, not because CASA deposits didn't grow, but just because the fixed deposits grew that much faster. Both of these have taken a few basis points each off the NIMs, but we still remain in our range of 4.1 to 4.4. As we move ahead, of course, the deposit side will continue to reprice because deposits reprice on maturity, and deposit rates we believe will continue to come down. Having said that, every quarter we will also have to recalibrate our base rate. So on the whole, we still believe the margins will remain in this range, and you could see slight movements in both directions along the way.
So can you give us a breakup of that 10 basis points that you just mentioned, Mr. Sukthankar? Because I didn't get all the points that you mentioned. The deposit growth, so how much did that contribute to the dip, and also you have cut the rates as well?
Clarify the cost of funds as a follow-up to the margin.
Yeah, sure. I'll do both, and they're sort of actually both related to the same point. As you're aware, when we dropped our base rate, right, and this was on the 1st of September, all our base rate linked loans, which are roughly 30% of our loan book, get repriced. Our deposits, obviously on the fixed deposit side, keep getting repriced as those come up for maturity. So to the extent that we had dropped rates prior to the base rate reduction and whatever we might have dropped thereafter, those deposits getting repriced will happen over a 3, 6, 9 month period. That would obviously give back a few basis points of NIM if you just look at the repricing of deposits in isolation. When it comes to the fixed deposit growth, which I was referring to, we're talking about proportion of deposits, and clearly if the fixed deposit growth has been in the mid to high 30s, while the other deposits, the CASA deposits, have grown at around 20 and 19%. Now both these in absolute growth rate terms are market leading. I mean, if you look at CASA growth in the system, it's been typically low double digit or even single digits for most of the industry players. So we've actually gained market share in CASA, but as a proportion of total deposits, it's about 39.7 or just under 40%. And that therefore takes a couple of basis points off the NIM. If you look at the asset growth again, apart from the advances growth, we've also seen some growth in the investment book, which was through investments in commercial paper and so on, because some of our corporate customers are borrowing through the CP route. Again, that at the margin comes with a slightly lower yield. So when you look at a combination of all of these, you will see that that 10 basis points reduction. I wouldn't be able to break up each component into 2 or 3 or 4, but the fact is that all of these contribute a couple of basis points to give that 10 basis point reduction. All of this again within that range which we have had, and I think has to be seen in the light of the overall balance sheet growth as well.
So Mr. Sukthankar, you haven't
loans to ARCs, or was there any 5/20 during the quarter?
No, we haven't sold any loans in this quarter.
Can you bring up the provision figure actually?
Sure. So when you look at the total provisions, there are again primarily 2 or 3 elements to it. There is the actual loan loss provision for NPLs during the quarter, and then you have general provisions for standard assets, and you have floating provisions. So if you look at the total provisions of 681 crores, 484 crores of that 681 number were the specific provisions for NPLs. The corresponding figure for that last year was 384 crores, but that 384 was net of a utilization of floating provisions last year. So strictly the comparable number would have been more like 420 crores or so. And then you'll find that the actual increases in provisions are primarily in the general provisions for standard assets, because the loan growth has been much stronger. So the general provisions for standard assets in the corresponding quarter of last year were 51.9 crores, and this quarter was 133.1 crores. So there's an increase of almost 81 crores in general provisions, driven by the asset growth or the loan growth that we've seen in this quarter. On the floating provision side, we've made floating provisions of 50 crores in this quarter. In the corresponding quarter of last year, we had actually utilized 30 crores. So that's the swing factor. As I mentioned earlier, asset quality in terms of gross NPAs have remained, very stable. So clearly the increase in provisions has more to do with the general provisions and floating provisions than any deterioration in the asset quality.
So, Mr. Sukthankar, I would like to come back to the NIMs. So, you did say that we are going to maintain this kind of a level. But going forward, my question is, first, you did not cut rates after the RBI's cut has happened. You preempted that, you did it much before that. So, is there an anticipation of another rate cut? Do you have scope for that? And second, if that happens, would that really impact your NIMs? And if that happens, which are the deliverables which would push the NIMs on the other side to offset it, if at all?
Well, so first of all, I think when you look at the base rate, all of us have to recalibrate our base rate at least once a quarter. So clearly the reduction that we did, which in that sense was prior to the last RBI policy rate cut, was based on the calculation that we did for the September quarter. So sometime during this quarter, we would naturally need to recalibrate our base rate once again. And depending on what the deposit rates are, which feed into the base rate calculation, clearly, we will come out with whatever the base rate is. Now, that's obviously something which we need to do between now and the end of the quarter. I don't want to preempt what might be the base rate or what will be the deposit rates at the time that we recalibrate that, but that is inevitable. To the extent that the deposit rates are on a downward trajectory, it would be reasonable to expect that there would be some reduction in base rates. That's the way the calculations work. Now, the actual the approach to base rate calculations and so on, of course, are again subject to some discussions which have been going on. So I think all of this will ultimately be a function of the way the calculations work at that point of time in terms of the regulatory prescriptions, as well as what our deposit rates are at the time that we recalibrate our base rates. The point I made was that because we do have a fairly well-matched book in terms of the duration of our deposits and our loans, we don't run gaps as a matter of policy. The fact that we have otherwise a healthy deposit franchise between the CASA and a retail fixed deposit franchise, which again allows us to get deposits at reasonable rates. The fact that we have an asset book which is well balanced between retail and wholesale and therefore gives us a good mix of yields. We believe that despite the repricing through of deposits and base rates, we should be able to maintain our NIMs in a range of 4.1 to 4.4. Now, I know this is something which we have done across interest rate cycles, across changes in deposit and lending rates, across different policy environments. But within that, we don't have a guidance on a quarterly basis or on an annual basis of movements in both directions. We are not, as a bank, in a strategy of maximizing growth or maximizing margins. We run our business in a manner where we balance our growth, our margins, and our asset quality on a sustained basis. And I think we are still...
All right, that's HDFC Bank. Stock is 0.00% on earnings day, but then that's